Hi everyone, my name is Victor Lai with BCM and welcome to part 1 of Investing 101. The purpose of this series is to provide people with information on some basic but very important long-term investing concepts and to do it in a way that's going to be easy to follow and understand. And hopefully everyone will enjoy it as well. Now we all know that there are lots of different ways we can invest, but regardless of how we do it, I think that investment decisions should be guided by an investor's needs and not by speculation about what the market may or may not do. Focusing on the investor means using a planning-based approach. It's a lot like driving. We need to know where points A and B are before we can find the best directions, and planning helps us connect the dots. One of the cornerstones of a planning-based approach is time horizon. Time horizon basically refers to the amount of time that money can be invested for, and that point alone can really influence what will or will not be appropriate. For example, someone who can stay invested for 20 years probably has different needs and should be doing something different than someone who can only invest for 1 year. A long-term time horizon, which I define as a period that's longer than 10 years, comes with a concern that is not really an issue in the short run. That concern is inflation, or how prices change over time. The blue line on this chart shows the inflation rates in the United States over the past 50 years. It's based on the CPI, or the Consumer Price Index, and CPI basically measures the changes in prices of a variety of goods. So by tracking the CPI, we can get a sense of how inflation is moving over time. There are different versions of the CPI, but that's not important for us right now because all we're looking for is a general idea of how inflation has moved over time. Looking at the chart, we can see that inflation has been pretty low over these past 2 decades, and we've been fortunate in that respect. But if we look at the 70s and the 80s, we can see that inflation was a lot higher. It got into the double digits even at some points. Now, nobody really knows exactly what inflation is going to be like next year or in 20 years. What we do know, however, is that over this time period, inflation has averaged about 4%, and that's shown by the red line that you see on the chart. In all likelihood, you and I, we're not going to notice that small of a change from year to year. If I have to pay $1 for a bottle of water today, and then I have to pay $1.04 next year, that's not going to impact my standard of living. Over time, however, it can. Now this table shows us the impact that inflation can have over time. The first column shows us 3 different inflation rates, 2%, 4%, and 6%. That would be below average, average, and above average, respectively. The second column shows us what $100 is worth today. The remaining columns show us the change in value of that $100 over time and after the corresponding level of inflation. For example, if we look at the 20 years column and then we pair it with the 4% inflation row, we can see that after 20 years of 4% inflation, $100 will only be worth $44 in value. That's like saying I put $1 in my pocket today, and when I go to spend it later, I find out I only have 44 cents. That's a big problem. And it's an even bigger problem if we assume a higher rate of inflation. Take a look at the bottom right corner of this table. What that is telling us is that $1 could erode to 8 cents in value after a long period of above average inflation. It would be practically worthless. Now, I think we all know people who refuse to invest because they don't want to lose any money. Of course, the irony is that doing nothing practically ensures losing. And the point is that even if we're not interested in growing our money, we should at the very least try and protect what we already have. And that becomes especially true for people who have long-term time horizons. Now, my opinion is that about inflation is that it's not going to be a big problem anytime soon. Down the line, however, it may very well be. And to see why, we just have to look at some of the things that are going on around us right now and think about how they might impact inflation. One of those things is the monetary base. The monetary base is just a fancy way of saying the amount of money in the economy. The chart you see on the left, that shows the monetary base in the United States over the past 50 years. The sharp increase that began in late '07, that is a direct result of our central bank, the Federal Reserve, injecting massive amounts of money into the economy during and after the financial crisis. Now, just looking at this chart alone, ignoring everything else, it's hard to imagine how this much money printing is not going to impact inflation, right? Something else we can look at are interest rates. Interest rates right now are at historic lows. All you have to do is take a look at your savings account and look at how little they're paying you to see how low those rates really are. When domestic interest rates are low, that makes our currency less attractive to foreigners, and as they sell our currency in favor of other currencies, that can impact inflation at home. Something else that's going on is the fact that we can't seem to get rid of our trade deficits with foreign countries like China. As deficits rise, what that means is that foreigners are holding more and more US dollars. And once again, that makes our currency less attractive, and that can contribute to inflationary pressures here at home. Some people argue that China is manipulating exchange rates, keeping its currency artificially low, thereby keeping the balance of trade in its favor. Now, while that may be true, if China allows its currency to appreciate, which it is actually doing now, that would imply a falling value for the US dollar. Regardless of what happens with exchange rates or foreign exchange, foreign trade, we know that here at home, our government is spending a lot more money than it's collecting in tax revenues, and that's leading to some of the highest levels of debt we've ever seen in this country. As debt levels rise, that influences the confidence that investors have not only in our economy, but in our currency as well. I think that we've all noticed the increase in prices of things like gas and food. Some people argue that these price increases are temporary. I disagree. If we look at what's going on around us, we can see that millions of people around the world in developing countries who are just starting to demand their share of the finite resources that were once reserved for countries like the United States. As long as the demand continues to increase, I think prices will as well. And what's strange is that all of these things can contribute to inflationary pressures, and yet they're all happening at a time when inflation is well below average. Inflation is very low from a historical perspective, and logically that just doesn't make a lot of sense to me. Now, I'm not saying that we are headed straight for a 1970s or 1980s type of inflationary environment tomorrow. I don't know. At the end of the day, nobody really does. However, I do think that it would be naive and foolish even to assume that it cannot happen and then find out all too late that we didn't save enough or do enough to prepare for it if it does happen. So the obvious question now is, what can we do as long-term investors to defend against inflation? And that's a question we'll answer in part 2 of Investing 101, which will be up shortly if it isn't already. As for now, I hope you enjoyed the presentation, or at least found it informative. And if you did, then please visit BCM's website at bellwethercm.com. Click on the contact page and check out the rest of our social media links. Please subscribe, follow, like, and share the content. And if you have any questions or comments, feel free to shoot me an email. Otherwise, thanks for watching, and I hope you'll be back soon.